Let me ask you something. You made a trade last week. You followed your plan. You set your stop loss. You sized your position correctly. You did everything right, and you got stopped out. So, you changed your strategy. Now here is another scenario. You broke your rules. You chased a pump. You didn't set a proper stop. You sized up out of emotion, and somehow you profited. So you thought maybe that was the right move after all. If either of those sounds like you, this is going to change the way you trade forever. Because here is the brutal truth that most traders never figure out until it is too late. The outcome of your trade has almost nothing to do with the quality of your decision. And until you understand that, you are not a trader. You are a gambler with a charting app. Why your last trade result means absolutely nothing. Every single trade you take exists inside a probabilistic environment. That means even the best setup in the world can fail. Even the worst analysis can accidentally win. The market does not care about your chart. It does not care about your setup. It definitely does not care about your feelings. What drives price in crypto? Liquidity flows, macro events, whale movements, sudden news, sentiment shifts. You cannot predict all of that. Nobody can. Here is what you cannot control: sudden volatility spikes, whale manipulation, news catalysts, random market noise. Here is what you absolutely can control: your entry criteria, your risk per trade, your stop-loss placement, your position sizing, and, most importantly, your emotional response. Professionals build their entire trading identity around that second list, not the result, the execution. Think about a surgeon for a second. A great surgeon isn't judged solely on whether the patient survives, because sometimes the patient was too far gone before they even hit the table. A great surgeon is judged on whether they performed the procedure correctly. Trading is the same. Your job is to execute the procedure. The market decides the outcome. The outcome bias trap. There's a psychological trap called outcome bias, and in crypto, it is absolutely lethal. It goes like this. You win a trade, and suddenly you feel like a genius. Your confidence spikes. You increase your position size on the next one. You lose a disciplined trade, and suddenly you doubt everything. You start tweaking your strategy. Maybe you scrap it entirely. You lose 2 or 3 in a row, and now you're switching systems, chasing a new indicator, or worse, revenge trading to get your money back. Sound familiar? I thought so. Here's the problem. A bad system can produce a winning trade. A great system will regularly produce losing trades. That is not a bug. That is literally how probability works. If you flip a coin 10 times, heads won't come up exactly 5 times. You might get 3, you might get 7, but flip it 1,000 times, you are going to be very close to 50-50. Your edge only reveals itself over a large sample size. 10 trades tells you almost nothing. 100 trades starts showing you the truth. So when you change your strategy after 3 losses, you are not making a smart decision. You are just letting short-term randomness rewrite your beliefs, and that is the fastest way to never become consistently profitable. So what does a real trading process actually look like? There are 5 pillars. These are not optional extras. These are the job. Pillar 1. A defined strategy with clear entry criteria. Not "this looks good," not "my gut says go." Your setup either meets specific, predetermined conditions or you don't touch it. Full stop. Pillar 2. A risk management framework. Fixed percentage risk per trade. Not based on how confident you feel. Not based on your last result. The number is the number, every single time. Pillar 3. A trade journal. And not just logging wins and losses. Log your reasoning. Log your execution quality. Log what you would do differently. This is where actual improvement happens. Pillar 4. A pre-trade checklist. Before you enter, you verify bias alignment, market structure, and liquidity levels. Every single trade, no exceptions. Pillar 5. Emotional rules. No revenge trading, no FOMO entries, no doubling down on losers. These are hard rules, not guidelines you follow when you feel like it. When these 5 things are locked in, something powerful happens. You become stable. And in a market as chaotic as crypto, stability is a superpower. The math of the game. Imagine you have a trading system with a 55% win rate and a 1-to-2 risk-to-reward ratio. That means you lose 45 out of every 100 trades, nearly half, and yet, mathematically, that system is profitable, consistently, over time. Because the math is not about winning every trade, it's about the relationship between your wins and your losses over a large enough sample size. The best traders in the world are not focused on being right, they are focused on executing correctly and letting probability do its job. This is why you see professional traders look almost bored after a losing trade. They are not in denial, they genuinely understand that one data point means nothing. They have made the mental shift from, "Did I win?" to, "Did I execute my plan?" That single reframe is worth more than any indicator or any signal you will ever buy. The trading reality. In trading, narratives rotate in days, not months. Liquidity shifts without warning. What looks like support on Tuesday can be a liquidation zone by Thursday. In that environment, emotion-driven trading doesn't just underperform, it can destroy an account in a matter of hours. Think about what volatility does to psychological weaknesses. Impatience becomes overtrading. Fear becomes exiting good positions too early. Greed becomes sizing up at exactly the wrong moment. But when everyone else is reacting to the noise, panic selling and FOMO buying, the disciplined trader is operating inside a clear framework. You are not trying to predict the market, you are trying to operate within it. That shift in thinking is what separates the accounts that survive long-term from the ones that blow up chasing the next 10x. Stop judging your trading on outcomes, start judging it on execution. After your next trade, win or lose, ask yourself one question. Did I follow my process perfectly? If the answer is yes, that was a good trade, even if it lost money. If the answer is no, that was a bad trade, even if it made money. Over time, that discipline compounds. Outcomes are short-term noise. Process is long-term power. Master your process, respect probabilities, and let outcomes take care of themselves. If this hit you differently than you expected, drop a comment below. Tell me, what is the biggest process mistake you've made? And if you know a trader who is too focused on results and not enough on their system, send this video to them.